are tuned in to the Loan Officer Podcast with me, Dustin Owen, and today I have with me one of my two business partners for the past 12 years, one of the best loan officers that I've ever had the opportunity to be around, but one of the best business minds that I've also been able to be around in. His name is Mike Smalley. Mike, you want to say hi to the audience?
Thanks for having me.
Good morning, good afternoon, or good evening, depending on what time you're tuned in and listening. That's always the best thing about a podcast. So they could be tuned into YouTube, watching us at 2 a.m. while eating their Captain Crunch cereal, or it may be 6 a.m. and they're driving in to work on their morning drive. But
Captain Crunch?
Captain Crunch, yeah.
No.
Oh, well, so if you've ever...
Raisin Nut Bran.
At 2 a.m.?
Well,
I'm talking about the munchies. I'm talking about I came home from the club and it's like 2 a.m. and I just got to eat something. It's either
Cinnamon Toast Crunch.
Okay. Cinnamon Toast Crunch, grilled cheese sandwich, or right now my go-to would be Captain Crunch. But nonetheless, so you're tuned into the Loan Officer Podcast, and we are in the droves of SARS-2, COVID-19, coronavirus, call it what you want. It sucks. And we're all making the best of it. We're trying to stay positive, and we're socially distancing ourselves. We're quarantining ourselves. Many of us are not leaving the house without having some kind of a nose and mouth covering, a mask, if you want to call it that. But I wanted to bring you on today, Mike, to get your insight or to help share our insight on how coronavirus is going to impact the housing market and how coronavirus is or is going to impact the housing finance or the mortgage arena.
Yeah, so I think the big answer is it depends on how long this lasts, right? I mean, if it's the 1st of April, we're in a shutdown pretty much nationwide till the end of the month. If you see the curve flatten and cases start to decline in 1st of May, we're kind of getting back to normal. I think that's a much different recovery than if at the end of April they say another 30 days. So it depends on the length of this, but I tend to view most things with a positive, glass half full mindset. And so I don't think it's going to be as bad as some people, but it depends on the length of time it takes to get back to normal. I do think the mistake some people are making is they're comparing the economy today and they're trying to compare it to the financial crisis of 2008 and 9. And I think this recession, crisis, whatever we want to call it, is going to be much more like the recession we had after the dot-com bubble in 2000 and 9/11. The 2008 recession was 100% brought on by real estate. You had a massive bubble. Real estate values were overinflated. You had stated income, liar loans, crazy products that people couldn't afford or understood. You had a lot of greed. People thought that, I got to get rich and buy multiple houses, which led people to making poor decisions. So the real estate market caused the last recession. And as a result, the real estate market was absolutely annihilated during the last recession. And values went down probably 50% in some areas. I think this is going to be more like 9/11, which is a strong economy going into it.
It was almost a red-hot economy.
Yeah, the dot-com bubble, but we weren't in a recession, really.
Yeah.
But the economy wasn't as strong as it was March 1st, back in 2001. But it was still strong. But you had a one-time, completely unexpected event that nobody, other than maybe some people in intelligence community saw, but nobody expected it to happen, right? Not in the scale that it did. Just like the coronavirus, and just like the coronavirus, if you think back to 9/11, those of us that were around and of 18 or older in the working world, people were scared. They were scared to travel. They were scared to go to big venues. We're in Orlando. It's like, do we go to Disney, or is there going to be a terrorist attack? I definitely don't want to get on an airplane. I remember me, you, and David, our other partner, flew to Milwaukee on September 11th, and it was like 2012. It's like 10 or 11 years after, and we were still kind of like, it's kind of weird to fly today. And, man, I don't know if I want to do this because, it could be like an anniversary, attack. And I remember that first year was weird. We've flown on 9/11 like 3 times since then because we have that fall meeting, it seems like every September that falls around that week. And now it doesn't seem really any different. But So I think this is a lot like 9/11, which is just fear and uncertainty. And just like nobody knew back then, when was the next terrorist attack going to happen? We had the shoe bomber, then you had anthrax, then you had that DC sniper, and people are panicked and freaking out over what's next. It's a lot like that right now. Nobody really knows, are we safe or not? Can I go to the gas station or not? So I think this recession, which we're in one, I mean, that we're going to have negative GDP in the first quarter just by the last 2 or 3 weeks of March.
And for the most part, we've been calling for a recession for the past 2 years.
Most people have, yeah.
Yeah, we just didn't know what was going to throw us into the recession.
Well, the financial crisis was so bad and the economy got hit so bad that coming out of that, until last Friday, it was like 112 weeks in a row, or 112 months in a row, sorry. It's like 11 years of positive jobs reports on a monthly basis. Maybe it was 9 years. But last Friday was the first negative jobs report since probably 2008 or 9. So we've had, and you hear this on TV, we've had the longest non-wartime economic expansion in the country's history.
Yeah, and it was slow. I mean, it was a turtle speed expansion, but it was still an expansion.
Yeah, the first couple years, 10, 11, 12, 13 was expansion, but at a slow pace. Last 6 years is when it's kind of really started, booming again. But so we were due for a recession just because everything's cyclical. Just like in our business, interest rates are going to go up and down. It's just a matter of when and to what degree. We were going to have a recession last year. Some people were thinking fourth quarter this year. The economy was still strong, so people were thinking maybe the first quarter of 2021. But in the next 18 months, we were going to have one. And I think when people hear the word recession, because the last one was so bad, they think like almost like depression, where all a recession means is you've had 2 quarters in a row of negative GDP.
Correct.
And it's just a slowdown.
Well, in 3 of the past 4 recessions, housing has gone up in value.
Correct.
With one exception, which is the recession that was caused by housing.
Right.
So 2007, 2008 was caused by housing. But other than that, and it's housing that typically pulls you out of a recession.
Right.
Because housing is such a large percentage of the overall economy.
Well, it stimulates the economy because people buy a home. When they buy a home, that means people get commission. That means a title company gets business. That means that Home Depot gets business because you're buying, the furniture store gets business. So housing stimulates a lot of like ancillary businesses, which is an even bigger percentage of the economy.
Yeah, I buy a house and I need to go get furniture for that house, and I need to have that house painted the colors I like it. And yeah. So there's a painter who now has a job. There's a flooring company who now has a job, and Best Buy and Home Depot are all going to get my business.
Yeah, cable company's got DirecTV has a new account. So
yeah. So would you say, and it's so hard because we are in unprecedented times, right? So we've never ever experienced anything like this in our lifetimes in the world as we know it, right? I mean, I think they're trying to go back and they're trying to learn from and correlate what we're experiencing to the Spanish flu of, was it 1918? Okay, well, our world...
I wasn't born yet.
No. I'm pretty sure no one listening, their grandparents probably weren't even born. How about that? So their grandparents weren't even born. So and it's so long ago, we can't really look at it as we correlate the fallout to the economy, because our economy is way different than it was 100 years ago. So when we're looking at things, like the first question, and I'm sure you've been getting these phone calls and I've been getting these phone calls, is, oh my God, is my house going to depreciate in value? Is my house going to plummet in value? How are you answering? I know how I've been answering those, but I'm curious, how have you been answering those questions when they come your way?
Yeah, so if you look at the last crash, what caused a declining home values was 2 things. So typically unemployment can be an indicator that leads to declining home values, because if someone is unemployed, they either can't pay their mortgage, which means they might default and there might be foreclosures, which means there's more inventory, and more inventory of homes means the price is going to go down, just law of supply and demand. I don't worry as much about that now, because heading into the crash of 2008, we were at about an 8-month supply of inventory nationwide. Right now, we're about a 3-month supply.
And healthy is deemed about 6-month supply, right?
Correct.
Yep.
Yeah, about 2 quarters.
So we were already unhealthy, meaning we were skewed out of market with not enough homes that were available for sale on the market.
Yeah, I had a client make an offer yesterday, April 5th, for $250,000, putting 20% down. He lost it there were multiple offers. Like, I don't know how there were even multiple offers on this house when nobody's really out and about seeing properties, but people are adapting. So that just tells me lack of inventory, because there can't be a lot of buyers making offers on houses right now, at least not as many as there typically are. So even with the whole coronavirus shelter in place, essential workers only, which real estate technically is one, they still had multiple offers on a house, which kind of blew my mind when I heard that yesterday.
That's good to hear, actually.
Yeah, I think so. I mean,
Yeah, it's a positive.
So, it's hard to determine what home value is going to do until we know when we're going to be out of this, because so I think there's three things that have to happen to stabilize the market. Okay, so the first is the Fed, the second was the government, and the third is kind of health. So as soon as this crash happened, you saw a big drop in interest rates, and that happened because the stock market sold off. And typically, when money comes out of stocks because the market's poor, people put money in a safe investment like bonds, and rates come down. So immediately we had rates come down, which is when we started getting really busy. Very quickly thereafter, the mortgage market, and this could be a whole nother show of what's happening in the secondary mortgage market and
it's
servicing
crazy.
and margin
It
calls.
is literally. I was trying to explain to Coleman, the producer of the show, earlier this morning, like red means black and up means down and left
Right.
means right. And that's, yeah, you're right. That's a whole separate show, but that would be geeking out for most people who tune in.
Yeah.
So we'll have to maybe even launch a different podcast
But
for that
so
one.
interest rates came down, like the market was behaving, normally. The stock market sold off, interest rates came down. Then for about 2 weeks, the market was behaving completely abnormally for many, many technical reasons. And rates went from upper threes to 3.1 all the way up to 4.25. And they went from 3.1 to 4.25, like in, 3 to 4 or 5 business days. At the same time, the stock market was selling off. There was a day when the stock market was down 2,500 points and interest rates went up 0.25%, which just makes no sense whatsoever.
Because typically it's the inverse, right?
Correct. If the stock market goes down, rates go down. But the stock market went down and rates went up, which that showed how unhealthy the market was. So about 3 weeks or so ago now, the Federal Reserve stepped in and announced something called QE, or quantitative easing, which basically means they're buying assets. In this case, the assets were mortgage bonds or treasury bonds. And that worked a little bit, but not all the way. Then they announced what everybody in the media is calling QE infinity, which essentially means the Fed said, we're going to do whatever it takes to stabilize the interest rate environment. So after the Fed announced QE infinity, and then they actually backed off a little bit last week because they got a little too aggressive, and I think they're probably at the right pace now, the mortgage market somewhat has stabilized as far as what are interest rates doing. So the rate environment has stabilized. The second thing that we needed to stabilize things was Congress had to pass that relief bill, and they had to do multiple things. It had to have increased unemployment for consumers, which it did. It had the ability for not only big businesses but small businesses to get loans to kind of help survive and cover their obligations, not just payroll but just to pay the bills. So that was passed. So if you look at someone losing their job and they're on unemployment, because of extending unemployment and the $1,200 or so plus $500 per kid, that whole scenario, people should have some money coming in over the next 30, 60 or longer period of time to at least, certainly not going to replace an income, but at least help. Help
it's a
cover
Band-Aid.
something.
It's a Band-Aid to help tie you over
Right,
until you can get back to work.
Yeah, we're tourniqueting a wound, So the bond market and the mortgage market and the interest rate environment has stabilized a little bit. As these checks start coming in, even people who are impacted by job loss or furlough will at least start to have some money coming in. I think a reason why you've seen unemployment claims hit record highs the last 2 weeks is because people knew that bill was going to pass and they could get quicker access to cash. I think a lot of companies did the right thing by actually laying people off, because most people know this, but not all. But if you're still working and you're getting less hours, you can't get unemployment. So you have to be laid off and let go. And it can't be you quitting. You have to be fired or laid off to get unemployment.
Yeah, because if I'm making even $25 an hour, but I'm only working 25 hours a week versus 40 to 45 hours a week,
that person's hurting.
I'm making less money than I could get via the stimulus package.
But potentially. Yeah. So now that's passed, things should start to stabilize a little bit. I don't think, there's no way for it to go perfectly. And you see some people complaining about the whole small business loan process and is that easier? But I mean, I'm not one to tend to say how great the government's doing at stuff, because usually they're not efficient. But I mean, you got to look at how many people are applying for it. It's going to take some time, but that should stabilize things a little bit. So you got the Fed, you have Congress passed a bill to stabilize things. The next thing that will give us some stability is just having an end in sight. And I think that's the only thing we don't have right now is an end in sight. So customers that we've worked with that have had their jobs furloughed, like Disney's a perfect example here. The when am I coming back to work date is TBD. My kids on my travel baseball team, hey, coach, when are we going to start practicing again? TBD.
TBD.
My team, when do we get to come to the office again? TBD. And so I think when that TBD is a date, which I think that date will be different in different cities and states throughout the country, but as things get back to normal and this curve, tends to kind of turn the other way and we get on the other side of this, that'll stabilize things. So the faster that happens, the less impact that has. But I don't think housing is going to have the crash like it did after the bubble, because housing didn't lead us into it. And I feel like Congress has a better handle on how to get people some cash to continue paying their bills in the interim, so you shouldn't see a rash of foreclosures. The next topic is the forbearance thing that's been talked about, and we can talk about that if you want to today, but that's a whole big convoluted subject. But the end result is you'll probably have fewer foreclosures, at least immediately. Like, there's probably still going to be some people that lose their homes because they lose their jobs and can't afford it. But some of the things that Congress has done and the forbearance packages that they're having lenders put in place, it still might be the same end result. Someone still might lose their house if they don't get back to work anytime soon. But if that's delayed and not just a big run of them at one time, then that'll stabilize prices too. So,
but two comments on the foreclosure / forbearance, and they're two separate. But my comment on the foreclosures is the one good thing we have going into 2020 versus 2008 is we are at a record high equity, meaning people are sitting on piles of cash in their home. Before, when we were doing 100% liar loans, people didn't have any equity. They had no skin in the game. They only had the option of walking away from their house, because the option of selling something that you're upside down on is impossible.
Yeah, if I have equity in my house, if I paid $200,000 for my house and now it's worth $250,000 and I'm sitting on $75,000 in equity, if I lose my job, worst case scenario, I can sell it, take the cash out, and I live on that cash for a little while. Where if I owed $250,000 and it was worth $225,000,
then you couldn't do anything. So we have that going for us. And then on the subject of forbearance, because we could probably do a whole entire show on forbearance, I'm just going to throw out these three caveats. A, please understand, this is for the listeners, forbearance is for people who truly need it, this is a last resort. I cannot afford groceries, or I cannot keep my electricity on unless I can forbear my payment. And understand that forbearance is not forgiveness. Forbearance is all you're doing is delaying the money that you do owe. And it's a little bit of a buyer beware. So if you are a homeowner or even a renter, because I know there's certain aspects where you can forbear your rent payments, please know that at the end of the day, the person you owe, in this case, let's call it your mortgage servicer, they're going to want and need their money. And certain servicers are going to require their money to be repaid to them over a 12-month period of time. Certain servicers would require a lump sum, well, hopefully a lump sum when you sell or pay off the mortgage in 25 years or 7 years or 3 years. But some, I believe, have the right to ask it on month 7. So you go 6 months. You're not making your mortgage payment of roughly $1,500 a month. That's $9,000 that you didn't have to pay. That's great.
You owe $10,500 in month 7.
Yeah. You owe month 7's payment plus the 6 months that you didn't pay. So I think that's just a little bit of a heads up, buyer beware. Look, if you need it, please take it. Right? If you need forbearance, please take it. But please know it's also there for a last resort, and you will owe the money.
Well, and you made a good point. If you can make your mortgage payment, because there's always going to be some type of impact, whether that's accrued interest or cash due or hit on your credit. Anytime you go in forbearance, there's going to be some type of impact. So if you can make your payment, make your payment. If it's between groceries and mortgage payment, then obviously, you got to buy the groceries first.
Well, sorry to cut you off, but a great example would be right now, in your personal pipeline, you are helping dozens of clients every single month save a couple $100s a month on their mortgage payment. You're helping them shave $10,000, $20,000 off of what they're going to owe over a lifetime. They're shaving 5 to 10 years off of how long it's going to take them to pay off their mortgage because you're doing refinances, right?
Yep.
Because one of the effects of the economic impact of COVID-19 and us going into a recession is mortgage rates drop from 4.5% down to 3.5%, maybe all the way down to 3%. And there's ways that consumers can take advantage of this. But if I was in forbearance or I'm currently in forbearance, am I going to be able to take advantage of a refinance?
Yeah, we think no.
Yeah.
I mean, that's typically what the underwriting guidelines are going to say is that if you're currently in forbearance, because to refinance, you have to have a clean payment history for the last 12 months. And if you're in forbearance, you don't have that. And before someone goes into forbearance, they just need to call their lender. Don't watch the news and hear I don't have to make a payment for 6 months and just stop paying.
Yeah, don't log on to Facebook.
Right. Like pick up the phone number, call the 800 number, and don't just talk to the person who answers. Ask for a supervisor. Like, get some documentation, get something in writing before you do it so you know what you're actually getting into, because different lenders will have different perspectives on what they can offer or will offer. And ideally, they say, hey, we're going to put these 6 payments on the end of your loan, and we're basically hitting pause. But they could say these 6 payments are due in month 7.
Well, and here's a key thing for the audience to understand is just because Fannie Mae and Freddie Mac allow it, just because HUD or Ginnie Mae allows it, doesn't mean the servicer has to do it one particular way. And that's where your point of make sure you ask all the right questions. You pick up the phone, you call. If you don't like the answers that you're getting from the customer service rep or they're not clear, ask for a supervisor and press them to make sure you understand what impact this will have on you in terms of when you owe that money back. Like that would be the one big thing on forbearance. So we kind of went down that rabbit hole, and I'm glad we did because it is a topic that people are gonna have questions on. But back on the future outlook, one thing that I wanted to tag along with you is, if we're out of this thing by like mid-May, like we're kids are back to school, we're finishing up the school year, by June we're going to the movies. This should be a blip on our radar. Like we had a strong enough economy coming into the year. Lawrence Yun, who is the, did I say that right? Lawrence Yun,
yeah.
Right? Lawrence Yun is the chief economist for the National Association of Realtors. And he's never been a propagandist, never been one that is, yes, he works for the National Association of Realtors, so they're obviously pro-housing, but he's still an economist. And he's calling for, nationally at least, home values to be the same at the end of the year as they were at the beginning of the year.
Yeah, I could see that if we get out of this and, it's April, sometime in May, we're getting back to normal. I would expect that to happen because the demand will keep values higher because we're still at a super light inventory market. I think the listing activity might slow down because people might be uncomfortable to list their house in May and have people come in the house. That might take longer than buyers to be comfortable seeing property. So you still might have a light inventory market even as we get out of this, which is something that always drives prices higher. So I don't think we're going to see prices going up. But
when affordability has just gone down. I mean, with mortgage rates dropping a full 1% over the past 6 weeks or 5 weeks, we've seen affordability.
Yeah, well, that's another
increase.
factor. So leading up to the crash of 2008, the average median income to buy a median priced house in your market, so nationwide, you had to make 25% of the median income is what was required to buy the median priced home in that area based on income and mortgage payments. Right now, you only have to make 14% of the median income to buy a median priced home, and that's kind of a national statistic, different in different markets. But I mean, you're talking,
So basically, two months ago, 25% of my pay went towards
in 2008.
In 2008. Oh, in 2008. Okay.
Yeah, 25% of my pay in 2008, that's what it would cost to buy the median priced home.
Okay.
Today it's 14%.
Wow.
So affordability is, we're significantly more affordable than we were in 2008. Part of that's because, we've seen home values go up, but income increases have paced with that, and part of that's interest rates. I mean, before the crash, interest rates were about 6.5%.
That's before the crash of 2008.
Correct.
Yep. And today we're locking in clients here at Waterstone
Yeah.
Mortgage at 3.5, pretty
yeah, you're in the low threes, mid threes range.
Yep. No, it's and I think that, but the one big unknown is there's two. It's if we're not out of this by mid-May, early June, or if it comes back. But right now, most economists, right, these are the smartest of the smart people. These are the subject matter experts, people we should be listening to. Not our next door neighbor, by the way, who likes to post stuff on social media, but the true 4 out of 5 dentists recommend Crest, so I brush my teeth with Crest. Yeah, 4 to 5 economists say X, Y, and Z. Well, what they're currently saying is that yes, we are going to see this massive kick to the gut when it comes to unemployment, but it's a temporary. It's not a systematic collapse because of bad decisions being made by companies. It's, hey, we were all told to go sit inside for the next 6 or 8 weeks and not to leave our house, which makes it hard to go spend money and be patrons to certain businesses. So therefore, those businesses had to put their employees on hold, right, on furlough. But the minute we get back to normal, they're going to need those employees, and they're going to want to be offering their services, and there's still going to be a plethora of people wanting their services. So hopefully this is nothing more than a pause button, and hopefully we all practice social distancing as recommended and wear our face mask and allow our first responders to do their job, and know that we'll still be here at Waterstone Mortgage and throughout other service-related businesses offering services to people so we can do our job, and together we can all get through this. Mike, if anyone listening has any questions pertaining to something that you had mentioned, brought up, or just in as it pertains to real estate or their home loan, how would they get a hold of you?
Well, they could probably just go through the Loan Officer Podcast Facebook page.
There you go. Okay.
Just reach us through there, because that message will get to all of us. And if you have questions about forbearance, obviously you're happy. You can call us at Waterstone Mortgage, and we can help. Even if we didn't originate your loan, we can help steer you in the right direction. We're probably then going to recommend after that to call your servicer directly. But if you need us to, help translate or give you some advice, we're happy to do that.
Heck, sometimes you just need help finding the phone number on your statement. Yeah, send us your statement. And heck, if you send us your statement, we may even give you a free mortgage review to let you know if a refinance makes sense for you or not. But look, we're in uncharted territory. The odds are forever in our favor. Like things are looking up. We are going to, obviously we're feeling the economic impact right now, but most economists are, if you think of the Nike swoosh or a hockey stick, that's what they're predicting our recovery to look like. So if you start at the bottom of a hockey stick, you see it jumps down pretty quickly, and then it goes on a nice steady incline of recovery. And that's what's being predicted. All should be good, and especially here in Central Florida, where we had one of the best economies and still have one of the best economies in the nation. And we are in a housing market that we need inventory. So any blip in sales will only help us come to a more healthy real estate market. And we're going to rely on real estate to do what it typically does in a time of recession, which is pull us out.
Yeah.
Well, that's it. That's all we have today for the Loan Officer Podcast with me, Dustin Owen, and my special guest, Mike Smalley. Mike, thanks for stopping by. Audience, thanks for tuning in, and we will catch you on the flip side of this COVID-19 crisis. Deuces.